Welcome everyone to the FAR webinar on Paycheck Protection Program 2.0, Everything Associations and Nonprofits Need to Know. I'm Donna Shafali, Executive Director of FAR, and FAR is the DC area's only association dedicated exclusively to nonprofit business leaders since 1983. We keep our fingers on the pulse of what is happening, the issues, the obstacles, and it is our objective to create educational opportunities to help each of you also adapt and learn in this very fluid environment in which we currently find ourselves. The driving force behind our mission are the many nonprofits and resource members who help to bring the most relevant programming, networking opportunities, and thought leadership to FAR. FAR has over 200 nonprofit associations and members, plus 60 prestigious firms that support our efforts. We greatly value our members and the partnerships of those firms that support us, and I would like to thank and acknowledge our gold level members as well as our silver level members. Again, like so many associations and nonprofits, we come to count on their partnerships to come alongside of us as we navigate the future. Most importantly, I just want to make sure, can somebody let me know that you're hearing me and everything is okay? Okay, great. I see some hands going up. Thank you. You never want to trust technology 100%. Good. Okay, most importantly today, I would like to also thank our three collaborators on the program. The Nonprofit Times, which is the leading business publication for nonprofit management, the Nonprofit Alliance, the voice of nonprofits, helping them to succeed in an ever more complicated fundraising and regulatory landscape, and the Direct Marketing Association of Washington, the organization dedicated to the education and training of nonprofit integrated direct response fundraisers, marketers, and engagement advocates. Jeff Tenenbaum has a lot of important information to share with all of you today, but I would be remiss if I did not quickly run through some of FAR's upcoming educational sessions. So hold on, I'm going to talk real fast to get through all of this so that we can also get to hear Jeff. If any of you are over 40, then you are or should be thinking about retirement and your investments. So I encourage you to take an hour out of your busy day and participate in our investment webinar, Tuesday, February 2nd. This session will offer ideas to help you look at fund choices, plan options, and resources for retirement planning, debt reduction, and budgeting. Then later on this month, we also have a webinar on leadership in times of change or crisis. To lead during the quiet times requires one set of skills, and then to lead during a crisis requires a whole nother skill set. And considering what we faced in 2020 and how 2021 is shaping up, as leaders, are you equipped to lead for more change? So on February 16th, we'll have speakers presenting information and ideas on how to keep your teams functioning, upbeat, and focused during these times of crisis. Analyzing your organization's office lease amid COVID and facilitating a safe re-entry is set for Tuesday, March 2nd. At this session, you'll learn the necessary steps that organizations need to learn to have their employees come back into the office. And since remote working seems to be so productive for so many organizations, many are reassessing their lease requirements. Do we really need this big of a footprint for office space? This webinar is going to look at those issues for you and help you assess your lease concerns. Then on March 16th, the webinar will dive into technology and keeping all of those remote employees connected and how best to use the technology available to you. Once a month, we have breakfast for our nonprofit members only. And that's in addition to our webinars. Now, these virtual breakfasts are limited to 20 people. Think of these breakfasts as birds of a feather type of sessions. This is where professionals get together, talk, and meet on a mutual concern, a peer-to-peer discussions. So on Tuesday, February 9th, we're going to be focused on preventing and detecting fraud in your organization. And then on March 9th, we're going to talk about association management systems. Please remember, these breakfasts are limited to only 20 people, so they fill up fast. Now, you can't have all work and no play, so we are planning a FAR happy hour next week, as a matter of fact. We're going to be doing one of these a quarter, and it's being held, in fact, the same day as the retirement webinar, so you can come celebrate your retirement plans if you'd like. We'll break out into small groups, we'll have games, we'll have prizes. Come and join us. It's a great way to get to know one another, at least until we get to start meeting in person again. If you haven't joined FAR yet, I encourage you to do so. All the webinars and breakfasts that we talk about now and that we're already planning are free to FAR members. So if you're not a member, I encourage you to join. We're putting on 20 webinars a year and at least 10 breakfasts a year. You do 3 webinars and 3 breakfasts, and you've already paid for your FAR membership, and it's well worth the investment. Please feel free to reach out to me, Executive Director at far-roundtable.org, or you can also write to hq@far-roundtable.org. In the meantime, if you have any topics that you would like FAR to address, don't hesitate to reach out. Today's program is approved for CPE and CAE credit. If you are going for the CPE credit, please be sure to take the poll questions. There are 3 poll questions that are going to be posed today. Please make sure you answer those poll questions, and then just write to us, hq@far-roundtable.org, and we'll send you a certificate. The last housekeeping remark is that please submit all your questions in the Q&A icon in the bottom. You should see it in the ribbon at the bottom. Submit all your questions there. We'll take all the questions at the end. Jeff does have, as I said, a lot of material. We're going to try to do everything in the allotted time. If we can't get all the questions answered in the allotted time, Jeff has been gracious to say we can go about another 10-15 minutes if need be. At the end of the session, you will be sent a survey. Please answer that survey, and you'll be sent a PDF of Jeff's PowerPoint, as well as a link to the recording. Okay, so now, today's topic needs no introduction, but for those of you that may not know Jeff, I do want you to hear about Jeff. He is one of the nation's leading nonprofit attorneys and is also an accomplished author, lecturer, and commentator on nonprofit legal matters. As managing partner of the nationally recognized Washington, D.C.-based Tenenbaum Law Group, Jeff Tenenbaum counsels his clients on a broad array of legal issues affecting trade and professional associations, charities, and other nonprofits. For 19 years, Jeff has practiced law at the Venable Law Firm and chaired its nonprofit practice for most of that time. Among numerous other honors and awards, Jeff was the 2006 recipient of the American Bar Association's Outstanding Nonprofit Lawyer of the Year Award, and is one of the only 5 lawyers in the prestigious U.S. Legal 500's Not-for-Profit Hall of Fame. Jeff is the author of the ASAE published book, Association Tax Compliance Guide, and currently serves as chair of the American Bar Association's Trade and Professional Association Subcommittee and on ASAE's Legal Advisory Council and Public Policy Committee. He is one busy expert, ladies and gentlemen, and we are honored and pleased to have him here. So Jeff, on that note, I'm going to turn off my webcam and leave it all to you. Let me do that, and you have control.
Thank you, Donna, and good afternoon, all of you. Welcome to our program today, Paycheck Protection Program 2.0, everything associations and nonprofits need to know. There is a lot to know here, a lot to know about this topic. I have been knee deep in this since this new law came into existence at the end of December of last year. I have been knee deep advising quite a number of associations and other nonprofit organizations, a lot of 501c3 nonprofits last year in kind of PPP, as I'll call it, 1.0, where 501c3s were eligible. And now this year, especially over the last few weeks, advising quite a number of 501c6 associations on these issues. While I am probably as well versed on these issues as anyone else at this point in the country, particularly as they apply to associations, there are still a lot of things that we don't know. There are still a lot of unanswered questions. The same thing happened last year, kind of in 1.0, when this law came in, this new program came into existence through the CARES Act. And it was only through the subsequent months, weeks and months, when the U.S. Small Business Administration and the U.S. Treasury Department continued to issue guidance to kind of fill in some of the blanks and answer questions. And I suspect that's what will happen this year, particularly through a series of FAQ documents that the SBA puts out. So here is our agenda for today. We have a lot of information to cram into about 50 minutes, but I'm going to try to get through it. As Donna said, please pose your questions in the Q&A box or the chat box, either one, and Donna will pose those to me at the appropriate times, if it makes sense, or at the end, if that seems to make more sense. So we're going to focus primarily, I'm going to focus primarily on the Federal Paycheck Protection Program changes that have occurred, particularly to open the program up to 501c6 trade and professional associations. We're going to delve into details about eligibility, loan forgiveness, and other issues relating to the PPP. And then toward the end, I've spent a little bit of time, not too much, on changes to the Federal Economic Injury Disaster Loan Program and to the Federal Employee Retention Tax Credit Program, particularly the latter. And then just a minute or so on some changes to the Federal Charitable Contribution Tax deductibility rules for this year. Okay, so how'd we get here? As part of the not so creatively titled Federal Consolidated Appropriations Act, 2021. One of the many titles of that in that act was the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. It was signed into law by then President Trump on December 27th, 2020. A very long bill, part of a $900 billion economic stimulus package. But most importantly for today's session, the act reauthorized lending under the Federal Paycheck Protection Program through March 31st of this year. There was $284.5 billion available now under this program. $35 billion was set aside for first-time borrowers like 501c6 associations. But that doesn't mean that only $35 billion is available for first-time borrowers. It's just that $35 billion was exclusively reserved for first-time borrowers. The rest of the money can be available to second-time borrowers. I'll explain that concept for those of you that work at or for 501c3 organizations that might have gotten a loan last year and are eligible for getting a second loan this year. But it is, just like last year, it's a first-come, first-served pot of money, and once it's gone, it's gone. Congress certainly may, like they did last year, reauthorize additional funding for the program, but they may not. And so we'll have to see what happens. But what that means is that if you have not yet applied for a PPP loan, and presumably you're probably on this webinar today because you have not, or you're in the process of, or you're considering applying, you definitely want to apply sooner rather than later. Loans are obtained through SBA, Small Business Administration approved lenders, but not through the SBA itself. If you're a 501c6 that applied for an EIDL loan, an Economic Injury Disaster Loan Program last year, which some did, those were direct loans through the SBA. These are just through private lenders that are approved by the SBA. And then this bolded bullet point, the most popular feature of this program is that the loans can be fully or partially forgivable if certain conditions are met, meaning you don't have to pay it back. It effectively turns it into a grant. And we'll talk about those conditions. I'm not going to cover every point in all of these slides. Okay, some key updates for 2021 PPP loans. First off, borrowers can set what's called the covered period of the loan. That basically means the end date of the loan to be between 8 and 24 weeks after the loan is dispersed. What that means is that the funds that you receive have to be spent on eligible expenses, and we'll talk about what those are during the covered period. So you can decide, and we'll get into a little bit later, why you might want to pick a shorter period or a longer period. It's going to vary for every organization. Borrowers that reduce wage or employment levels, wage meaning total salaries or employment levels meaning total number of employees during the covered period, can lose loan forgiveness unless one of two safe harbors excludes those reductions. And we'll talk about those later. And then finally, there are some additional expenses that PPP loans can be used to cover. The basic construct is that 60% of the loan proceeds have to be used on what are called payroll costs. That's specifically wages, employer paid payroll taxes, paid leave, healthcare payments like premiums, retirement plan contributions, and group life, disability, dental, and vision insurance. Those are new additions to the definition of payroll costs. So you have to spend at least 60% on that. The whole idea is that you're trying to spend money on your employees to keep people employed. That's the whole, as the name of the program, Paycheck Protection Program suggests, that's the whole idea behind it. However, up to 40% can be used on other eligible expenses. And I'll get into more detail later as to what those are. And that the categories of eligible expenses have been expanded this year, which is helpful. And I see a question about association management companies. I actually have a slide on that, and that's a very nuanced, complicated, and difficult issue, but I will get into that if it's okay with you when I get to that slide. For nonprofits, as I said earlier, PPP eligibility has been expanded to include 501c6 organizations. C3s are still eligible, and it's only C3s or C19s, which are veterans organizations, those for which they can receive tax-deductible charitable contributions, and C6s, but not other types of nonprofits like C4s, C5s are not eligible. And then the primary focus of the PPP program is small businesses, small for-profit businesses. There is greater flexibility for seasonal employees. It's not really relevant to associations. There is additional funding available for entities that returned their original amount or did not receive the full amount for which they qualified last year. And then this is an important concept. The law creates this distinction between first draw loans and second draw loans. So first draw loans, and I did a webinar on this yesterday and some people were confused. So let me just make sure I explain this well. I will try to explain it well. First draw loans means your first PPP loan, whether it was last year or this year. So if you're a C3 organization and you got one last year, that was a first draw loan, meaning if you go and you apply again, assuming you qualify, we'll talk about that, then you would be getting a second draw loan. The rules are somewhat similar, but there are some notable differences, which we'll talk about. But if you're a C6 organization, presuming you did not get one last year, there were some C6s that applied and kind of slipped through the cracks and got approved, but they weren't supposed to. If you were one of those that got one last year, then if you applied again, assuming you qualified, it would be a second draw loan. But for most C6s, it's going to be considered a first draw loan. One of the main differences is that there's a maximum loan limit. So the way you determine the loan amount that you're able to qualify for, assuming you otherwise meet the qualification requirements, the loan amount is essentially 2.5 times your average monthly payroll costs. And I'll get into the details of that in a bit. Or either 10 million or $2 million, whichever is lesser. So the lesser of 2.5 times your average monthly payroll costs, or $10 million if it's a first draw loan, or the lesser of 2.5 times your average monthly payroll cost, or $2 million, whichever is lower if it's a second draw loan. So there's a lower kind of global limit cap for second draw loans than first draw loans. The practical reality is most associations, unless you're really, really large and have very, very large payroll costs, the lesser number is always going to be 2.5 times your average monthly payroll cost. But for some very large ones, you might be looking at numbers above that. And we worked with a number of C3s last year that did get some larger loans. Okay, the timeline for applications. Loans reopened on January 11th, starting with community financial institutions. All lenders, participating lenders, were able to start offering, opening their loan portals up on January 18th. And this is important. The loan deadline application deadline is March 31st of this year. No first draw or second draw loan applications can be submitted after that. So you don't have a lot of time. And like I said earlier, the money is likely going to run out. It may or may not. We don't know. And like I said, we don't know if Congress would authorize more money. That would likely, the PPP program itself is actually has a lot of bipartisan support on Capitol Hill, which is a rare thing to say these days. But the problem is that it's any authorization of additional money would be wrapped up in a lot of other COVID-related relief issues that are much more controversial. Okay, so these are kind of entities that are eligible for first draw loans, and this list has been expanded significantly compared to last year. But the most notable thing here is 501c6 associations. I'm not going to go through the rest of this. But I wanted to leave it for you there for reference. And Donna, I'll turn this over to you.
All right, great. For our, here comes our first poll.
You know what, Donna,
We
actually haven't covered this yet.
That's right. It's coming up next. You're
just inserted in the wrong place. I'll come back to this in a second after I cover this.
Okay, so.
Okay, so 501c6 organizations. This came from some senators. I think it was led, if I remember, by Marco Rubio from Florida. He was concerned that PPP money not go to, what he considered to be lobbying organizations, and so he pushed. And we're going to go back to that poll question after I finish this slide, because the poll question should have come after this slide. 501c6 organizations, to be eligible, not only do you have to be a 501c6 organization, but some other eligibility requirements. A, you have to have 300 or fewer full and part-time employees. So it's not 300 FTEs, it's 300 full and part-time. If you had, I don't know, say 10 full-time employees and 5 part-time employees, that would be 15 employees. Most associations are going to be under this, but not all. So the smaller organizations, and that's less than the for the general qualification, like for small businesses and whatnot, for first draw loans is 500 or fewer employees, but for C6s it's a lower limit. So they wanted to limit it to the smaller organizations. And then there's this lobbying test that essentially says, A, you can't get more than 15% of your receipts from lobbying. I'll talk about that in a second. Second, your lobbying activities cannot constitute more than 15% of your total activities. Talk about that. And then finally, you cannot spend more than $1 million total on lobbying for the most recent tax year that ended prior to February 15th of last year. So it's kind of, you have to, if you don't meet any of those three, you're going to be knocked out from eligibility. Most associations, the vast majority, are not going to run into this as an issue, because at least based on survey data from ASCE and whatnot, most associations do not spend more than 15% of their budget on lobbying, which is kind of that second part of the test. At least we believe that's how SBA is going to interpret it, to look at expenses. How much did you spend on lobbying compared to your total budget? And if it's less than 15%, then you're going to be fine. The 15% receipts from lobbying, it's odd terminology because if you look on the 990 or whatnot, you don't see a category for lobbying receipts or lobbying revenues, because generally, unless an association is like making special assessments for lobbying, lobbying is generally funded from membership dues and conference revenue and other things like that. It's not specifically funded for lobbying. This was really more directed at lobbying firms that might be organized as C6s that actually get paid for lobbying. So we don't know for sure until the SBA comes out with more guidance. But for now, I don't really view that as a real issue unless you get funding specifically for lobbying and it was greater than 15%. But for now, I think you can kind of take that one and push it to the side and not really have to take that into account. Certainly, if your lobbying expenses on your Form 990 are more than 15% of your total expenses, that's going to be a problem and you're not going to qualify. And if your lobbying expense total on the 990 is greater than $1 million in that last fiscal year, you're not going to qualify. And then there's that final requirement: you can't be organized for the purpose of promoting or participating in a political campaign. And as you probably know, political campaign activities are different from lobbying activities. One last point on this: there's some question as to what is the definition of lobbying activities. And for those of you who don't know, there are many different definitions of lobbying activities out there. There's the federal tax law definition for C6s under the lobbying tax law, section 162E of the tax code. There's lobbying definitions for C3 organizations, which is not relevant here. There's actually two different sets of lobbying definitions in the tax code for C3s. There's the Federal Lobbying Disclosure Act, which has very different definitions of lobbying. So these things include certain things. They don't include other things like legislative versus regulatory lobbying versus grassroots lobbying. The law just doesn't specify what the definition is. However, we have heard some reports that SBA is likely going to say that you should use IRS Form 990 data, which would mean the 162E tax code definition for C6 lobbying, which means, as I state here, federal, state, and local legislative lobbying, grassroots lobbying, political campaign activities like money that you spend to administer and fundraise for your connected PAC, Political Action Committee, and certain very high level federal executive branch lobbying, like when you're lobbying cabinet secretaries, their immediate deputy, and quite a number of officials in the White House and the executive offices. That's the federal tax code definition of lobbying. So I think I've covered this enough. And with that, let me go back to the poll question. Donna?
Whoop. Okay, I'm gonna. So if you paid attention to Jeff, you should be able to get this question. And they did. All right, we'll give it another few moments here. Give everybody a chance to vote.
It's not letting me vote.
No, Jeff, you know the answer.
If you guys do not know the answer to this, I'm going to be extremely disappointed.
All right, we're getting ready to close. 3, 2, 1, and we're closing voting. And I'm sharing the results, and you'll see that some people did say under 25 and one said under 30, but the majority did catch that it was under 15.
All good. All right.
All good, everybody. Thank you. I'm going to close that. Let me hold on here, Jeff. Let me get rid of that for you. And
Okay. I'm going to move on here. Now, we had a question about this. I've been getting a lot of questions about this. This is a tough one. It's a nuanced one. So for those of you that associations, C6 associations that have your own direct employees, you can take a few minute break from the presentation here. But for those of you that work for or advise or whatnot, associations that are managed by association management companies, here's the issue here, and it's about as clear as mud. First off, AMCs themselves, association management companies, which are for-profit taxable businesses, if they have less than 500 employees or less than 300 employees for second draw loans, then they themselves are eligible for Paycheck Protection Program loans. And many AMCs, probably most from what I can gather, last year did apply for and receive Paycheck Protection Program loans. Most of their clients, most of which are C6 organizations, there are some C3 clients of AMCs, but generally they tend to be C6s. They were not eligible last year, so this was not an issue. But in the FAQs that the SBA put out last year, they put out 3 different sets, and then they kept kind of updating and adding to them. And at the end of my presentation, I have a bunch of links to external resources, mainly on the SBA website. I have a link to this FAQ at issue. And it was last updated in December last year. So it applied to last year's PPP program, but it's still very much relevant this year. The SBA has said all the rules that were in place last year still apply this year unless they were modified by the new law. And this was not modified. There's an FAQ that says that if an entity uses a professional employer organization called a PEO or similar payroll providers, and we don't know what that means. So in a PEO arrangement, generally, it's what's considered a co-employer or a joint employer situation. So the PEO has the staff on the payroll handles all the, the payroll tax remittance and paychecks and paycheck issuance and all the direct deposits and all of that stuff. They handle all of that. But the employees, and they're considered a co-employee of the PEO as well as a co-employee of the client organization, whether it's a nonprofit, for-profit, whatever. That's a long-established principle. And in those situations, even though the payroll is done by the PEO, what the SBA said in this FAQ is that the client entity is able to still qualify for a Paycheck Protection Program loan because they do have employees. They're just joint employees. They're co-employees. And the FAQ has, as you see there, like toward the bottom, the second to the last bullet point, a mechanism for how the PEO can tell the client, kind of, here's the allocable portion of your wages, employee benefits, and payroll taxes, employer paid payroll taxes for your employees, your co-employees, so that you can use that information to apply for a PPP loan. And lenders, banks should be the ones who are processing PPP applications, should have been familiar with that from last year to the extent they ran into it, and hopefully are familiar with it this year. Now that C6s are eligible, it's become a much bigger question, and I've gotten it quite a number of times, as to whether 501c6 organizations that are clients of AMCs that don't have their own payroll, whether they would qualify for a PPP loan. And the short answer is we just don't know. We just don't know. You can make an argument either way. I think, one argument you would make is that because most AMC contracts with their clients do not refer to the employees as joint employees, they refer to them as just employees of the AMC. Taking that approach, you look at it and say, well, the AMC client clearly doesn't have its own employees. It's not a joint employer situation like a PEO. It's a similar structure, but it has some nuanced differences. So the clients, the associations, should not qualify. On the other hand, there's no question, at least in my mind, that there are things that the association, like the association's board, if it took some adverse action, got an employee fired, and engaged in some discriminatory or harassing behavior or something like that, there's no question that the association could be liable for some of those actions as what's called a joint employer. And now the contract might try to structure it differently, but it's still, in my mind, there has some potential elements of a joint employer relationship. And this reference to the similar payroll provider could well be interpreted to include AMCs. The SBA has not issued any guidance on this. And so, like I said, you can make the argument either way. I believe there is a good faith basis for making the interpretation that would allow the association to apply for a PPP loan. But I've only just heard recently of several association clients of AMCs that have submitted their PPP loans. We haven't seen yet whether those loan applications have been accepted and approved or not. So we should get some evidence, not that that's going to be particularly telling because a lot of stuff slipped through the banks last year that shouldn't have. But I believe there is a good faith basis for making that interpretation. And I also think that as long as you're making a good faith basis, the risk is very low. And worst case scenario, you don't get loan forgiven. At least in my mind, the worst case scenario is you don't get your loan forgiven. It's a loan with 1% interest and you have 5 years to pay it back, which is certainly not the end of the world. So AMC client is going to have to make its own decision on this, but that's the way that I see the landscape. And then finally, this is really important. The FAQ, the last sentence of it, which I have listed there at the bottom, basically says you can't use the same wages twice. So if, let's say, an AMC had 4 clients and it only has 4 clients, it doesn't do anything else, and all 4 clients are going to apply for a PPP loan. So it's taking the wages and benefits and everything and dividing them up, allocating between the 4 on whatever basis they do that. If all 4 association clients applied, then the AMC itself would not be able to apply for a second draw PPP loan or a first draw if they had last year, because there would be no other wages. They can't use the same wages twice. You can't use the same wages to qualify the association client as well as to qualify the AMC. So hopefully that answers your questions. It certainly doesn't give you anything definitive, but that's what I know. Okay, first draw PPP loans, eligibility criteria. First, you cannot have received a PPP loan under the CARES Act last year. or you now qualify for an increase of the original loan amount because the calculation, the definition of payroll costs has expanded, and been expanded retroactively. So if you're a C3 that applied last year, you may well be able, it might not be worth it if it's a small dollar amount, but if it's a significant dollar amount, it might be worth getting an increase of your original PPP loan amount. But basically, this is for C6s that, for instance, did not get a loan last year. 500 or fewer employees, although, as I said earlier, C6 organizations are subject to that sublimit of 300 or fewer employees. The applicant must have been in operation as of February 15th of last year. And now this last bullet point, this is the most important thing to take away from this: eligibility. So you're going to see a very different test for second draw loans, but for first draw loans, this is the basic test that the SBA calls the necessity test. And essentially, the borrowers have to certify in good faith that your PPP loan is necessary. So what does that mean? It means before you submit the application, you should carefully review the required certification, which you have to certify under penalty of perjury, whatever officer is going to be signing the application, that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. You have to make it in good faith, taking into account your current business activity and your ability to access other sources of liquidity sufficient to support your ongoing operations in a manner that's not significantly detrimental to the business. So a couple of takeaways. One, I don't think many associations are going to have trouble making that certification in good faith. However, there are some clients of ours that actually did better financially in 2020 than in 2019. That they would not be in a position to make that certification in good faith. But if your revenues were down, you had to cancel your in-person conferences, you lost a lot of money, things like that, there should be no problem making that certification. But everyone has to make it on a case-by-case basis. And then the second part of it, I've gotten this question a lot. If you have access to other loan money, or if you have a lot of reserves, do you have to tap into those sources of money first before making the certification? And the answer seems to be no. First off, there's no SBA guidance that says you need to do that. And secondly, there have been thousands, probably hundreds of thousands of organizations that got approved for PPP loans last year that had significant reserves and were not required to tap those in order to be eligible for a PPP loan. So unless and until SBA says otherwise, that should not be a factor. Second draw loan. So it's a lower eligibility limit, 300 or fewer full or part-time employees, the same as for C6 organizations for a first draw loan. And then the second bullet point, this is the most important thing here. So you have the necessity test still. It's right there at the bottom bullet point. And sorry for these dense PowerPoint slides. I tend to not like to use PowerPoints if I can avoid them. This stuff is too complicated to avoid it, and I am the worst PowerPoint creator. I make them too dense, no graphics, difficult to read, but at least it'll be a good resource for you going forward. So in addition to the necessity test for second draw loans, there's a tighter standard that you have to meet in order to show eligibility. And what that essentially is that you have to show a 25% drop in revenue in a single quarter in 2020 as compared to 2019. So you can pick whatever quarter you want. And most associations are picking the quarter, say when they would be booking their revenue from their annual conference, because that's where most of the losses seem to have occurred. But regardless, you pick any quarter where you had at least a 25% revenue reduction, and you can demonstrate that through financial statements, bank statements, or your IRS Form 990 if that's been the 990s if those have been filed. And they may not well have been, but you can use any of those things, but you're going to have to provide documentation to the lender, to the bank, as to that 25% drop in revenue. Alternatively, you can look at the whole year, comparing 2020 to 2019, if that's more favorable, to show a 25% reduction, but generally most associations seem to be picking one quarter. I may get questions later or now about how do you cash versus accrual accounting, and how you calculate what numbers fall into what quarter. And unfortunately, I am not an accountant. I do not have answers for you on that question. I was speaking to a CPA who I'm doing a panel on this for ASAE tomorrow. And he has a much more nuanced understanding. He said basically when we were talking to the extent that you can just rely on the financial reporting that's done on your Form 990. That would likely be what SBA is going to be looking for, but we just don't have definitive guidance on this. Another thing, for loan amounts that are $150,000 or less, so for smaller organizations with smaller payrolls, if it's $150,000 or less, you don't have to provide the documentation of the 25% quarter over quarter reduction in your initial application, but you do need to provide it later before you seek loan forgiveness. And we'll talk about the forgiveness part later. And then the full amount of the first draw loan must have been spent on eligible expenses if you want to qualify. So that's second draw eligibility criteria. Excluded entities, I'm not really going to talk about this except to highlight this second bullet point, which is that if you're an organization that has a Chinese resident sitting on your board, you would not be eligible to apply for a second draw loan. We actually have a client that is in that situation. Okay, so the loan amount. This looks complicated. It's not really that complicated. Let me try to keep it simple for you. So told you it's basically 2.5 times your average monthly payroll costs. How do you determine what those average monthly payroll costs are? Well, first, you pick what's called your reference period. That's what they call it, your reference period. It's either the calendar year 2019, the calendar year 2020, or the 1-year period before the date on which the first draw loan is made. So you pick one of those periods. You're going to pick whatever number has the highest payroll cost. That's your reference period. So you take your payroll for the year. You subtract any salary, cash compensation paid to employees in excess of $100,000. You can include the $100,000 mark, but if an employee gets paid $150,000 salary, you would exclude $50,000 from the calculation. Divide it by 12 to get the average monthly payroll, and then multiply that by 2.5 times. So 2.5 times the average monthly payroll cost. And then if you did have an EIDL loan from last year, other than the $10,000, what's called an advance that you're able to keep as a grant and not have to repay, the rest you can actually roll into this, essentially refinance it as part of the payroll protection program loan. Okay. Are employer costs for health benefits and retirement added to the $100,000 for payroll costs? Yes. That definition I read you earlier of payroll costs, it includes not just salary, but those benefits, retirement plan, employer paid payroll taxes. Yes. Why is this? Okay. Eligible uses of funds. So you figure out what your qualifying amount is. You go ahead and you qualify for the loan and you get your distribution. You get your loan money. Now, what can you spend it on? So remember, you have this requirement to spend at least 60% on payroll costs, but then the other 48% can be spent on other eligible expenses. It's not all expenses, it's eligible expenses. So the payroll costs we already talked about. The other expenses you can spend it on are rent, covered mortgage interest, utilities, and then these last 4 bullet points. Certain worker protection and facility modification expenses related to COVID, property damage costs related to public disturbances in 2020 that were not covered by insurance, expenditures related to suppliers that are essential at the time of purchase to the recipient's current operations. That's a pretty broad category that should allow for a lot of covered expenses. And then covered operating expenditures, but specifically only these things that are listed here: payments for business software, cloud computing service that facilitates business operations, product or service delivery, processing, payment and tracking and payroll expenses, all human resource related expenses, sales and billing functions, and accounting or tracking of supplies, inventory records, and expenses. So it's a pretty decent bucket. It's expanded significantly from last year's program under the CARES Act. And it makes it easier in terms of what you can spend that other 40% on. Of course, you could spend the whole 100% of it on payroll costs if you have enough to cover it, but it's going to vary for every organization. Now, for a C6 organization, there is a specific prohibition that you can, isn't health insurance and ER retirement contributions added to the payroll costs? Yes, that's what I said. It's all included in payroll costs. All of those things are definitely included. For a C6 organization, well, not just a C6 organization, any organization. It could be a for-profit that does lobbying, but any organization, you cannot use the proceeds of a PPP loan for lobbying expenditures. And this is defined very broadly. So they actually tie in the Federal Lobbying Disclosure Act definition of lobbying activities, but then they also add on lobbying expenses related to a state and local election, which are basically state and local political campaign expenses. And then any expenses designed to influence the enactment of legislation, appropriations, regulation, administrative action, or executive order proposed or pending before Congress or any state government, legislature, or local legislative body. So it's very broad. It basically means any federal, state, or local legislative or administrative lobbying. You cannot use your funds for that. Now, what does that mean? I got this question yesterday, and I hadn't really thought it through until then. But what does it mean? Obviously, spending money on outside lobbyists is not going to be allowed. But what about for your government affairs, your public policy staff that spend some of their time, presumably at least, on lobbying? Lobbying is defined by this slide, by this requirement, not as, for instance, this is broader than just the federal tax code definition for 501c6 lobbying. It's broader because it includes all of this administrative lobbying that's not covered by the lobbying tax law for C6 organizations. So my thinking is that in terms of spending it on payroll costs, if you have an employee who you estimate, and you're going to have to do estimates because even though you're probably hopefully tracking lobbying time for things like the Lobbying Disclosure Act or the 501c6 tax law definition of lobbying, and you're allowed to use your tax law tracking to report under the LDA. So if you're probably going to have to estimate, because you're tracking for lobbying tax law purposes is not going to be a broad enough definition. It's not going to include that federal and state administrative lobbying. But let's just say you take the lobbying tracking that you do, you add in some extra amount, and you come to an estimate that Jane Doe in your public policy department, she spends 75% of her time on lobbying as defined here, and then 25% on other things. My thinking is that when you are then using the loan proceeds and applying them to payroll, you could only use it to apply to 25% of her salary during that covered period, whatever that, remember, you have to pick an 8 to 24 week period. And during that period, you would not be able to spend it on the 75% of her salary, which is allocable to lobbying. So this is going to be a little bit trickier to figure out. It's going to make more work for the accountants and the finance folks, but that's how I interpret that, at least. Okay, Donna, you're up for a poll question.
Okay, gives you a chance to take it. There you go. All right. Let's go for the second one. And there we go. Which one is true? The maximum covered period that borrowers may choose in which to spend their loan proceeds. And we'll give this a few seconds more. Now remember, this is the maximum. And we do have lots of questions, Jeff. I've got, so when you get to the end, we'll do the best we can to get through those.
All right, I'm glad you told me that. I'm going to try to power through this pretty quickly, and I'm not going to spend much time on those last couple topics.
I'm going to close the polling and share the results. And the one that is true, which one is true? Maximum covered period. We offered 8 weeks, 24, or 36. And those of you that answered 24, you're the winner. All right, Jeff, I'm going to close this out and give it back to you.
Great, thank you. Okay. And by the way, on that covered period, well, we're going to talk about it right here. You choose that covered period ranging from 8 weeks to 24 weeks. And what that means, as I said, you have to spend the funds on eligible expenses during that covered period if you want to get maximum loan forgiveness. There have been some, I read a lot of other, folks, accounting firm, law firms, other banks kind of summaries of this new PPP program when it first came out. There were a number that mistakenly said that you choose either 8 weeks or 24 weeks, and that is not the case. You can choose any period within that range. A few other hallmarks here: 100% guaranteed by the federal government, no collateral is required, no personal guarantees are required. For any portion of the loan that doesn't get forgiven, it's a 1% interest rate. Maturity period is 5 years. So they're not bad loan terms at all. Now, loan forgiveness. The reason that you're probably getting in this game is not just to get a 1% interest loan, but to try to get it forgiven and to help keep your employees, keep their compensation levels high, or at the same level, etc. So if during that 8 to 24 week period, covered period following loan disbursement, you maintain employee and compensation levels, and I'll talk about that in a minute. Second, the loan proceeds are spent on payroll costs and other eligible expenses, and at least 60% of the proceeds are spent on payroll costs, and the remaining 40% or less is spent on other eligible expenses. If those things happen, you will qualify for maximum 100% loan forgiveness. Here again is that definition of payroll costs, so you know what I'm referring to. Here again is the simplified definition of these other expenses that are covered. There's more detail on that prior slide. And then the last two bullet points are safe harbors that they're important, especially the first one. I think is going to be the most relevant. So the idea is you need to keep the same number of employees to the extent possible. But if you have a reduction in up to 25% of salaries, if total salaries go down, you have to do some pay cuts and whatnot to get through these tough economic times. If during that covered period you reduce salaries by say 24% overall, your total salary pool goes down 24%. That's a safe harbor, and there will be no reduction in the 100% loan forgiveness. That'll still be okay. So it's letting you reduce it, by up to 24.9%. But anything over, up to 25%, but anything over 25%, if you reduce salaries, if you have no choice, you have to do pay cuts that, or even greater than that, say 30% pay cuts, then there will be a reduction in loan forgiveness, but it's going to be a commensurate reduction, based on whatever percentage you're going over 25%. So that's a very important and helpful safe harbor. And then the other safe harbor is that if you have a reduction in headcount of greater than 25%, so this is related to headcount, not salaries. And if you cannot find employees to rehire, or if your organization is shut down due to COVID, not likely going to be the scenario for most associations, then that's a second safe harbor. That's more designed for businesses like restaurants and whatnot that have been shut down due to governmental orders. Real briefly, for those of you that might be smaller organizations taking a loan of $150,000 or less, the loan forgiveness process is much easier. You don't have to provide any documentation like everyone else that has a loan over 150K will need to. You just have to make a certification that states the number of employees that you're able to retain, the estimated total amount of the loan spent on payroll costs, the total loan amount, the amount spent on eligible expenses, and then you have to maintain records to prove compliance, and you might be subject to audit. So while you still do have to submit documentation to show the 25% quarter-to-quarter reduction from 2019 to 2020 in gross receipts, you don't have to provide any other documentation, which is helpful. This is for any AMCs out there, this is applicable to you, but for tax-exempt organizations, this is not relevant. Finally, and I want to make sure we leave plenty of time for questions, this is the Economic Injury Disaster Loan Program. It's a program that's been around for many years, but it was expanded last year to apply to a broader pool, which included 501c6 organizations, and a number did apply for these loans. So they're not forgivable loans, but they're still pretty favorable terms. You apply directly with the SBA. It's a fairly easy loan application, but they did tighten up the qualification requirements this year. And if you see here, to qualify, an applicant must, among other things, be located in a low-income community, which is something that a lot of associations might well not be able to meet that qualification requirement. Have suffered an economic loss greater than 30%. Again, a lot of associations won't qualify. And third, employ not more than 300 people. So if you meet those requirements, you could apply for an EIDL. Frankly, if you're going to be eligible for a PPP loan, that would definitely be the way to go. But for some reason you don't qualify, you might consider an EIDL. And the first $10,000 of that loan is considered an advance that does not have to be repaid. and that is limited. It's determined by $1,000 per employee up to a maximum of $10,000. So if you have 20 employees, you can still only get $10,000 as that advance amount. That doesn't have to be paid back. Carries a 3.75 interest rate, 30-year maturity. By the way, what's that question? If a C6 used the ERC, let me wait. I'm going to get to that. The ERC or ERTC, I've heard it referred to both ways. The employee retention tax credit, I'm going to talk about here in a second. But back to this EIDL loan program, you do have to provide collateral for over $25,000 loans, although I was told by a number of associations that applied for these last year that they were not actually, in fact, required to provide collateral for loans over 25K, even though the rules say that they do. And then personal guarantees are required for any loans over $200,000. Again, Donna, this is premature. This poll question should have come after the ERTC discussion, so I will come back to this momentarily after we finish this. So this is really the last topic I'm going to talk about, the employee retention tax credit. I'm not going to spend much time on it because I don't know that a lot of associations are going to qualify for it because it's a fairly steep hurdle to overcome to qualify. But if you do, this is a notable change from last year. Last year, the rule was if you got a PPP loan, you could not take advantage of the employee retention tax credit. That is no longer the case. You can, and in fact, this change is retroactive to last year. So if you are eligible, you can actually go back and take advantage of this to be able to apply for this tax credit. So this is a tax credit. You might be thinking, well, we're tax exempt organizations. Why do we worry about a tax credit? This is not a tax credit for corporate income taxes. It's a tax credit for payroll taxes, for the federal employer-paid payroll taxes, specifically the 6.2% employer-paid Social Security payroll tax. So that does apply to associations, and it's a refundable tax credit. So if the credit exceeds the payroll taxes due, you can actually get a refund. And qualified wages under this program are those that were paid after March 12th of last year, which was the effective date of the CARES Act, and before July 1st of this year. Here's the eligibility requirements. And this is why it's tough. So these first two bullet points are alternatives. If you see the word "or" there, you have to meet one of these. The first one I think is going to be really tough for most associations to meet and nonprofits. It says the credit's available to employers with operations that are either fully or partially suspended by a COVID-19 governmental order, and only during the period that the order was in force. Partially suspended means operations continue, but not in a normal capacity. For most associations and nonprofits, they've been able to switch to a virtual workforce, continue most of their operations. Obviously, not things like holding in-person conferences, but pivoting to virtual conferences. I think it's going to be a tough standard for most associations to meet and to, in good faith, make that certification. The second one, some associations and nonprofits may be able to meet, but it's steep. So the term is a significant decline in gross receipts. And there's two different definitions for 2020 versus 2021. So for 2020, the definition of a significant decline means, this is really complicated. And I don't want to make your head spin. It basically means the first calendar quarter after December 31st of 2019, in which gross receipts are less than 50% of the amount in the corresponding prior year quarter, and ending with the next quarter in which gross receipts expanded by 80% of the corresponding prior year quarter. Yeah, if that doesn't make your head explode, I don't know what will. But essentially, it's a pretty significant reduction in revenues. And yes, we will be sending a PDF of the PowerPoint slides to everyone afterward. And it's also posted on our firm's website. You'll see our information at the end of the slide deck. For 2021, eligibility has been expanded by reducing the required year-over-year gross receipts decline from 50% to 20%, and providing a safe harbor, allowing the use of prior quarter gross receipts to determine eligibility. It's more likely that a number of associations will qualify for the 2021 wages, which, as you recall from my last slide, it would run from January 1st of 2021 to July 1st of 2021. So you got 6 months there. that you might well be able to take advantage of it if your revenues are down 20%. And the definition of gross receipts for nonprofits for tax-exempt organizations includes contributions, gifts, grants, dues, and assessments, sales and receipts from unrelated business activities, the sale of assets, and investment income. Eligible size of employees, 500 full or part-time employees or fewer. Most associations are going to qualify. It used to be a 100 employee limit. That's changed. And then the amount of the credit that you get for 2021, the tax credit is 70% of qualified wages plus the cost to continue providing health benefits to the employee. So this is not an insignificant credit. And you absolutely should take a look at whether you apply. For last year, the tax credit was 50% of qualified wages. And then finally, basically some expansion of who is eligible to take charitable tax deductions, as well as the limits that are imposed on individuals and corporations for the maximum amount of charitable tax deductions you can take each year. There was an expansion on those things last year under the CARES Act, and those have now been continued through 2021. So that is a benefit for 501c3s that are looking to use that to help solicit additional charitable contributions from individuals and corporations, and certainly for-profit businesses and individuals that want to take advantage of charitable tax deductions. Actually, I need to go back to that poll question on the ERTC. So Donna, take this last one away.
I'm going to launch that poll. And all right, so which eligibility requirements, which eligibility requirement below is false regarding qualification for the employee retention tax credit? Employer that received or receives a PPP loan is no longer prohibited from claiming the ERTC. As of January 2021, the threshold increased to 100 full and part-time employees. Previously, this was 75. And the final choice is the ERTC is available to employers with operations that are either fully or partially suspended by a COVID-19 governmental order, or that sustain a significant decline in gross receipts. We'll give it another few seconds as people are still voting. Going once, going twice, and we'll end the polling. Whoops, got another coming in. Okay. All right, ending polling. And the majority, 64%, said that the false one was the second one, which is correct. Jeff, I think it was the I forget the increase to 300, was it?
Yeah, no, it's 500, I believe, is now the limit. It's either 500 or 300. Let's see here.
Yeah, it was.
And it used to be 100. So yeah, most of you got that correct.
Correct. Okay, so I'm gonna. Whoops, I'm going to use the mouse for a moment just to get rid of the. There, okay, and it's back to you, Jeff.
Thank you, Donna. Okay, yeah, here's the number. So it's 500 or less employees, used to be 100 last year. There was a question that someone asked, if you took advantage of the ERTC last year, does that in any way prohibit you or limit your ability to apply for a PPP loan this year? And the answer is no, it does not. They made that very clear, in part because the changes in this ERTC program were made retroactive to last year. So it will not in any way affect your ability to apply for a PPP loan. But actually, I just remembered, I skipped over this slide. So this is the maximum tax credit amount. So for last year, for the March 12th or December 31st, the tax credit cap is $5,000 per employee. Beginning in January 1st of this year, the tax credit cap increased to $7,000 per employee for each of the first 2 quarters of 2021, which means you can get a possible credit of up to $14,000 per employee. So this is nothing to sneeze at, and it's available tax credit is available even if the employer received a $5,000 maximum credit for wages paid to such employees in 2020. And then finally, this is important, wages that are used for the ERTC cannot be used to obtain PPP loan forgiveness. So I had a question yesterday from one of the participants in a webinar who said, and I thought it was interesting, and I have to sit down and do the math, which is not my strong suit, to figure this out, but you actually might want to pick a covered period that's longer than 8 weeks, maybe even as long as 24 weeks. If you want, because you can't double dip the wages. You can't use the same wages to get a tax credit that you also use to get a PPP loan that's forgiven. But if you spread out the covered period for the PPP loan to a longer period, then you should have wages that are not kind of being sucked into the PPP loan that would be available for you to use for the ERTC. So that's something to keep in mind. And also, remember, I gave you that example for those of you that do a decent amount of lobbying, to the extent that you have your employees who are doing lobbying, you can't spend the PPP loan on those dollars for the allocable portion of their salaries and benefits and whatnot to go to lobbying. I don't believe there's any similar restriction for the ERTC. So that's just something to keep in mind as you do your calculations. I know there are a number of associations that are working with their accountants and the finance departments to kind of figure out what should they do, what's going to give maximum advantage, what are they going to qualify for. Of course, you have to meet these qualification requirements. That means economic injury and whatnot, meeting the necessity test and whatnot. But these programs are here. You should take advantage of them if you qualify, for sure. And finally, this is a list of, do we use Form 990 Schedule C for total lobbying costs? The answer is, right now, that's what I think you should use. We don't have, and we suspect that's what SBA, if they do come out and say anything on this, and if some of the folks in ASAE's public policy department don't believe they're actually going to weigh in on this. But for now, I think there's no question that those are the numbers you should use for lobbying expenses from your Schedule C of the 990. These are all links that you'll be able to click through when you get the PDF of the PowerPoint presentation. Virtually all these are on the SBA website. They have a special COVID section. They call it COVID-19 guidance and resources. All of these things are there, but I made it easier for you to find these things. The interim final rules are what the SBA issued a couple weeks ago for both first and second draw loans, as well as loan forgiveness, 3 different interim final rules. Those will at some point be converted to final rules, and there likely will be changes. This is what happened last year. And then those FAQ documents, there were ones that existed last year, and then they've already put out one FAQ document for first draw loans and one for second draw loans. And then I linked to that one about association management companies and PEOs. So anyway, those are all there, as well as the full text of the underlying federal law. So that is it. Okay. Don, you help me in posing some. I
was going to say, let me get some of these questions going and see if we can power through them, a bunch of them, because we have like 26 lined up. So we're going to try to hit everybody quick and hard. Jeff, do you know what the normal turnaround time is from application to receiving funds?
I don't, because it's also new.
And it will vary from bank to bank. It's
definitely going to vary.
For sure.
Unfortunately, I don't have any insight on that yet.
A number of jurisdictions have ruled that they will conform to the federal treatment of the non-taxability of PPP loan forgiveness and not subject the forgiveness to state income tax. However, Virginia has not released guidance yet. Does it mean that the PPP loan amount will be taxable for us located in Virginia?
First off, I don't believe that this is relevant to tax exempt organizations, because even at the state corporate income tax level, I can't see a basis for why this would be taxable income. I mean, for it to be taxable, it'd have to be unrelated business income. And I don't see any trade or business activity, and it's certainly not a regularly carried on activity. Even if you said it's not substantially related to your mission and purpose, I don't. Anyway, I just don't think that's an issue for tax exempt organizations. If you're a for-profit company or an AMC, it's a different story. And I just don't have any insight on that with regard to Virginia, but I am familiar with the issue you're talking about.
Okay. Are freelancers covered in the 40% outside of payroll expenses? I know we do, and a lot of other organizations use freelance writers for, or in this case, for a scientific newsletter. Can they include those expenses?
Yeah, so actually, the PowerPoint is down, but
Oh, I'm sorry. You want me to?
I'm looking I'm at my own slides on this to see. I believe in the definition of eligible expenses, and the slide that I have on that is, let me see here. There is one category. Yeah, here it is. Expenditures to suppliers that are essential at the time of purchase to the recipient's current operations. You know, that arguably might fall under that. I mean, maybe that's not the best interpretation of that, you know, that a freelance writer, for instance, might not be considered a supplier. They didn't say vendors, they said suppliers. That's one category it might fall under. Product or service delivery is another. Operating expenditures for product or service delivery. I think that's probably a stronger argument that it might fall under that. But what is clear is that payments to independent contractors are not going to be included in payroll costs. That much is clear. But I think there's a strong argument that things like that could be covered in the 40%.
Okay. If the 990 is being used for lobbying amount, would it likely be Schedule C amount or Part 9, which is just third-party lobbying? Have you heard anything about using LDA reports for that amount? Similarly, for receipts calculated, should associations use the percent of dues estimated to going for lobbying, also reported on Schedule C?
Okay, first off, no, this would not just be third-party lobbying. It's going to be the total lobbying expense amount. That's what I've been advising clients, and I think that's without question, I think that's going to have to be the answer, because it includes your staff time and related allocable overhead and other things spent on lobbying. The only reference to using, you know, the LDA definition of lobbying is that, remember that one slide that said none of these PPP loans can be used on lobbying as broadly defined to mean essentially lobbying in any sense of the word. Federal, state, or local, legislative, and regulatory lobbying, and grassroots lobbying, kind of all of the above. So that's the only place that the LDA is referenced in the law or in the rules. We don't know yet, though. ASAE has been lobbying, so to speak, the SBA and Treasury on this issue. They've actually asked for LDA numbers to be able to be utilized, thinking that that's a more beneficial set of definitions for this purpose, but we just don't know. And right now, my best guess is that SBA, if they come out with guidance, are going to say use the 990 numbers. And then, yeah, this is an interesting question, and this is why I hedged a little bit in my slide about this. Well, there's that reference to you can't get more than 15% of your receipts from lobbying. While associations generally don't, most of the time aren't, you know, having special assessments that are assessed to fund lobbying activities, that would certainly be considered a lobbying receipt. That same lobbying tax law under Section 162E requires you, as you all probably well know, this law has been around since 1993. It's kind of where I cut my teeth on association tax issues when I was working at ASAE at the time when this law was enacted. That law requires you to take your total lobbying expenses divided by your total dues, membership dues, and other similar income, and the resulting percentage is the percentage by which your membership dues are non-deductible to the members as a business expense. So it's possible that SBA could come out and say that you have to take that non-deductible percentage is what they're going to consider receipts for lobbying expenses. It wouldn't shock me if they did that. I don't think that's what Congress intended, but it wouldn't shock me if they did that. Right now, I don't believe that's the case. And right now, most associations don't have a greater than 15% non-deductibility percentage, but I know that some do. But I just can't give you a definitive answer on that. I see this question: if an AMC received a first draw loan last year and doesn't qualify for a second draw loan, can any or all of their C3 and C6 clients apply for the second draw loan? So in terms of the double dipping issue, there would be no double dipping issue if the AMC is not applying for a second draw loan because it doesn't qualify. But on the issue of whether their C3 or C6 clients would qualify, that's what I spent 10 minutes talking about earlier. And that's kind of everything I can tell you at this point. To C6 organizations applying for a loan of less than $2 million still retain the SBA safe harbor. Certifying the organization made their needs assessment in good faith. Was the safe harbor eliminated as part of the new law? Now, if you're if the loan amount, so it's C6, it would be presumably a first draw loan. So a loan amount would be the 2.5 times the average monthly payroll cost, or $10 million, whichever is lesser. There was that $2 million. You're referring to it as a safe harbor. If I recall, what they said last year was that they weren't going to audit recipients of loans. They weren't going to automatically audit recipients of loans that had less than $2 million, but they were going to audit all recipients over $2 million. I believe that's what they said. They did, in fact, and continue to audit recipients that had loans of less than $2 million, just not all of them. They've done it kind of sporadically. I'm aware of a number that have gone through those audits. Either way, you still have to make the good faith needs assessment, and it's very important. It's under penalty of perjury. And like I said, if your revenues didn't go down to some material degree, or if you otherwise didn't suffer some significant adverse economic consequences, I don't think you're going to be able to make the certification. But if you did go down, having a material reduction, even though you might have several $1 million or more in reserves and investments and whatnot, there's nothing to suggest that you would not qualify or be able to make that certification in good faith. Have you heard anything about forgiveness being required before second draw loan is approved? I don't believe so. One of the requirements you might recall from the slides on second draw loans said that you have to have spent all of your first draw loan money on eligible expenses before you can apply for a second draw loan. I don't recall seeing anything that said that your forgiveness application had to be approved, but yeah, it looks like your bank is saying that they can't process it until the loan forgiveness is recognized. That may well be the case. I don't recall seeing anything on that. It may just be the practical issue that the bank's not going to move forward until that forgiveness application is approved, which is unfortunate. And I'm not sure what you can do about that.
Jeff, I want to be respectful of everybody's time. We do have over 20 more questions, but it is 2:18. So
why don't we take 2 more questions and then
questions? Okay. I want to try to make them good, that everybody, and not just specific to a particular group.
Here's one. Do I understand correctly that each employee is capped at $100,000 when calculating the loan amount? So it's not gross payroll. It needs to be calculated adding up each employee. Essentially, yes. I mean, or another way to do it is you could take the total payroll for the year, whether you can pick 2019, 2020, or that 1 year period leading up to the loan application date. But then you have to subtract any salary amounts over $100,000. So that's how you have to do it. And by the way, I don't know if I said this earlier, it's in the deck, but this only applies for employees that live in the US, that reside in the US. If they reside overseas, you can't count them here.
How about, have you heard anything about forgiveness being required before the second draw is approved? Somebody's forgiveness application is in process and their lender was told our application could not be accepted while the forgiveness is pending.
Yeah, that was the question we just talked about. Someone else.
Sorry, I thought it was the other one. How does Best a Nonprofit show they fully spent all PPP funds to get maximum loan forgiveness when they can only use PPP funds on activities that are funded with unrestricted dollars versus restricted funds, so as to not double dip? This gets very complicated with allocations of non-payroll costs.
I think that's a little bit beyond the scope of this program. Whoever asked that question, feel free to reach out to me directly. But it's going to be too specific, I think, to cover here.
Okay.
Can an organization receive more than one EIDL loan? Well, if you received an EIDL loan last year and then you wanted to apply again, I believe that you can. Don't take that to the bank, so to speak, but I don't recall anything saying that you could not apply for a second EIDL loan. I think that was part of the reasoning behind it. But remember, just because you might be not prohibited from applying for a second one, you still have to make sure you meet the eligibility requirements.
I have one here. So the ERTC includes first quarter of 2020. If you had major investment losses that brings your overall receipts below 50% of the 2019 comparison quarter, you'd qualify, right?
Sorry, I'm gonna go back to my own slides here to take a look at that to double check. Can you repeat it one more time, and then we're gonna have to wrap up?
Tell you what, I'll put it in the chat to you so you can see it.
Okay. Yeah, you know what? Again, so that's going to require, and I'm looking at that slide, it's slide 24, that definition of a significant decline in gross receipts. And especially for 2020, it's a very complicated test that I'm still, frankly, getting my arms around. So take a look at that test there, and then feel free to reach out to me offline. I'd be happy to help.
Okay. And I have another ERTC one. If I'd like your thoughts on gross receipts for ERTC, page 1 of Form 990, box G contains gross receipts pulled from Part 8, which includes proceeds from investment sales rather than the realized gain. It would seem unfair to exempt organizations, but it seems like this is the amount to use.
You know, I'm looking at the definition. It just says investment income, and it says, for example, interest, dividends, rents, and royalties. I really don't have any, and I don't think that there is any guidance beyond that. I believe that reference to that definition is a reference to somewhere in the Internal Revenue Code where that definition comes from. But I unfortunately can't offer anything more than that right now.
All right, I think, Jeff, we'll call it done. How's that?
I think that's good. I do need to get running.
Yeah.
Thank you, everyone, for participating. Thanks for the great questions, and hope you got a lot out of this.
Jeff, again, thank you so much. I greatly appreciate it. Your time, your expertise. I know this is a complicated issue and one that doesn't get answered in 30 seconds. So again, we greatly appreciate it. To all of our participants, thank you for taking the time, especially those of you who stayed that little extra time. Greatly appreciate it. I'm going to let all of you go. Stay well, stay healthy, and go after those PPP loans. Take care, everybody. Bye-bye.